Run us through the kind of tone that's been set for the trading week ahead and what your expectations are on that front.
Similar to last week, I expect that the trading week will be a bit slow. We are bound to see a bit of liquidation, especially by the local institutions, as people look for liquid money to invest in the bond sector. I believe the bonds might see a bit of activity as opposed to the equities.
Of course, this should be holding true for Safaricaom, because where Safaricaom has in the past managed to, to attract quite a bit of foreign investor, we've seen modest attention being paid to that stock. How much of that can be attributed to the fact that we have the upcoming launch of a Safaricaom bond on the cards?
Quite a bit, a big fraction, because as we've seen, foreign investors always have, over the past few months, we've seen both psychological entry and exit levels. At 350, they have the entry level, and about 390, they have the psychological exit levels. But I believe they want to mop up a bit of the shares, expecting that the bond that Safaricaom is going to do for about 11.2B will push up the stock price and is bound to act in favor of them entering at this price.
In the meantime, local investors' attention seems to have diverted towards Total Kenya. Can you explain some of the attraction and the merit towards investing in that stock right now?
Similar to Safaricaom in terms of exit and entry levels, we've seen that Total usually tends to attract investors at levels of 28, who enter and maybe make a few coins here and there and exit at levels of above 30, between 30 and 33. Also pegged on the same notion, Total has been a consistent dividend payer, giving about 8% against its market share price. We've seen it give it about 2 shillings 50. And I believe, pegged on the history of Total, I believe Total is still a good buy.
On that note, Robert, we're going to have to leave it there. Thanks so much for having joined us this morning. That, of course, Robert Kihara of Dyer and Blair Investment Bank joining us live from our studios over in Nairobi, Kenya. And we're going to be getting into further analysis with AlyKhan Satchu from Rich Management in just a bit. But before we do, let's take a look at some of the news highlights that have emerged on the Kenyan local scene. The Daily Nation running with the story on Access Kenya, saying that the IT firm has struck a deal with Indian firm Tata Communications to establish a local access point for the telecom operator. The internet protocol for the point of presence is configured to offer redundant paths for internet traffic going north towards Europe and southwards towards South Africa as well as to Asia and India over the CFC cable system. This protocol will have the benefit of higher speeds on the one hand and accessing this direct link between Kenya and other world destinations as well. In the meantime, the Standard running with the story that the Central Bank of Kenya has said that the high cost of energy due to a series of poor rains will most likely escalate the cost of living over in Kenya, but the bank does not expect food inflation to worsen as the short-term rains are expected to continue in October. And if you remember, we had Leon Myberg of City over in studio a couple of weeks ago saying that the rains are coming. Well, to get some more insight into the market, let's cross over to Nairobi right now to chat to AlyKhan Satchu, CEO at Rich Management. And first things first, AlyKhan, welcome back. It's good to see you once again.
It's good to see you too, Alishia.
Well, when it comes to the banking arena, I mean, that's really what's dominated a lot of attention of late. And the argument that's come to the fore in recent times is that the positive assessment of the bank's performance have been driven by the examination of profitability as opposed to the risk inherent to their business models or assets. Do you agree with at all with that kind of sentiment that's out there?
Well, I think they have outstanding profitability here in Kenya because of the wide spreads between the deposit and the lending rates, admittedly coming under some compression pressure lately because of the outsized borrowing going on in the government bond market. But I think the statement is putting the point out that the banks have a higher degree of embedded credit risk than maybe is being shown, in the results as we speak. I'm not so sure that the credit risk is as high as that statement is implying. I actually think there's sufficient cushion here, and we are really in the L right now. So therefore, this is the moment when we should see any sort of missteps and we have seen them pretty much.
Let's take a look at a key example here, and I'm going to use CFC Stanbic because it was out with numbers recently. It showed that earnings per share rose 51%, so a near doubling, and the market was certainly impressed with the numbers it put out there. A net interest income rises by 61% as well, so that providing nice support. But what stands out is the fact that while we saw loans up 15%, provision for bad loans almost tripled. So is that a concern for you and triggering any alarm bells at all?
Well, I think that's a specific situation. You must remember that Stanbic actually took a majority stake in CFC not so long ago, and I think, you know, it is a sensible business decision in that sort of environment to throw everything, the baby and the bathwater, into the provisions, so that as you look forward, you've really taken all that you need to take. So I think in this particular instance, you've got an organization really clearing the decks, saying we're going to take everything on the chin and you're going to get no more surprises. So I think actually for me it was a positive signal that the management is on top of it and actually provisioning correctly here, with room to then take back some money over the next 24 months.
Of course, the darling of the sector when it came to this latest set of releases specifically was Standard Chartered. It was a bank that outperformed with pre-tax profit growth at 43%. The banks that were conservative, it seems to have done, you know, particularly well. That being Standard Chartered and Barclays as well. Do you see more of a shift in strategy emerging from your other players like KCB and Equity that have been so focused most specifically on regional expansion?
That's an interesting question, and if I might first say, Standard Chartered did not grow in 2008. And they were left with a very trim balance sheet, which they then put to work from the beginning of this year to very good effect, and that's why you saw those results. I do sense that, you know, Equity Bank is highly correlated to GDP. It has the largest number of customers, and therefore, you know, their results, when you contextualize what was happening to GDP over the last 12 to 18 months, were perfectly respectable. Regarding the regional growth, I think most banks post-2008, when we had all that trouble here in Kenya, have really gone for the regional footprint with a vengeance. And you can see that across the big banks, the mid caps, and everyone has a great focus. And I think that's a sensible one, because it's the aggregate market that really is where the juice lies in the Swahili sphere that includes between 160 to 180 million people. So I think that's right. But I think the disruptive risk to the banks remains the mobile phone. And I think, you know, you are now seeing more and more language. Etemesi of Standard Chartered in particular said that, you know, he's looking to bolt on a much more mobile platform onto his network. And I think those banks that are ahead of the curve will reap a good reward in this regard, I think.
Well, seeing that the Kenyan banking activity is viewed as an indicator for the stock market and the health of the broader economy as well, what are your prospects on that front moving forward in terms of broader economic growth?
Well, I think, you know, we are in the L, as we all said before. There is a big outsized bet on ICT, which I think will come off in the next 6 to 12 months, which will add some muscularity to GDP. But we remain beholden to the rains for the economy as a whole. There are lots of meteorological assessments saying we're about to get hit with some serious rains. You know, the proof's in the pudding, and it's not so long to go. And I think that's the key driver for the economy in the very, very short term. It's the hydrology side and it's the farming side. But looking through that noise, you have to say that money has chased the bond market, has chased the real estate market, and left the equity market very much on its knees. It does not take very much extra incremental money to send this market up. If you look at emerging markets today, we're trading at a PE of 20. If you look at frontier markets, we're trading at a PE of 13. It strikes me that African stock markets are very undervalued, and you will see some spillover of capital allocation imminently, I think.